Interest rates are above 7%. Everyone's concerned, but here's some reasons why rates are going downward, and don't take my word for it. Okay, well, a lot has happened, especially last week. There was lots of fireworks with interest rates moving above 7%, which has not occurred since 2008. So I know that everybody feels the impact of these sharp increase in rates when we communicate with our leads and our clients and our partners. And we certainly want to remain optimistic and talk about our recovery in our markets and our business, and especially the opportunities to help buyers and homeowners. But do we really believe that rates are heading downward, or is this just wishful thinking? So there's a lot of talking heads out there, just like me, talking about interest rates going up and downward, but don't listen to me about that. Let's take a look at what history and other events that have unfolded really talk about interest rates going down to support this. So here's some indications. The first one, the Fed. So there's a lot of nerds like me that really analyze the Fed minutes and look at what was said and what wasn't said. So last week, a lot of things happened. We saw interest rates move up significantly, and that was really based on what the Federal Reserve spoke about. What triggered the markets going upward was not that they were increasing short-term rates. It's because they had talked about not decreasing rates next year in 2023. What's crazy about this is we have never been in a cycle where the Federal Reserve, at the same time that they're talking about stalling economic growth and increasing short-term interest rates, that they simultaneously talked about decreasing interest rates. It is crazy, but that's never happened before in the Federal Reserve with all their policy and their talk. So a lot of it's very bland and not very exciting, but there is some real important indicators on what they've said. Number two, so debt levels. So in the US, debt levels are currently at 31 trillion and they're growing rapidly. So rising rates accelerates the debt, and it also widens the deficit as revenue decreases. So the US policymakers are certainly very concerned about this debt level, and it's going to continue to be played up in the media, especially over the next 2 years as we head into midterms and a presidential election in 2024. So number three, rate sheets. So if you are a lender or you know a lender, certainly take a look at rate sheets. They certainly tell a story of rates being flat. And what this means is not that they're priced higher margins, because most lenders are priced very aggressively right now. But what it does mean is lenders are pricing in a way that they anticipate loans to be paid off in the very short term. And we see this in the spread in rates versus origination cost. Number four, rate hikes. So we expect rate hikes in short-term rates of at least 75 more basis points later this year, early next year. And we're now talking about something that hasn't happened since the 1980s. So there's going to be over 400 basis points in increases to short-term interest rates over a 12-month period. Yes, that has not happened since the 1980s. And we certainly remember what happened, or we have heard stories about the impact of inflation in the 80s. Number five, Fed policy. So since the Clinton administration, Fed policy has really been based on, unfortunately, punishing savers and rewarding the stock market. So although this hasn't occurred this year, do look for this trend to continue. Number six, so manipulation of economic reports. So this started back in the Obama administration, and we always see economic data being manipulated or revised. So this will continue as the Fed is always concerned about finding ways to manage short-term sentiment and consumer confidence. So don't trust all the economic reports and outlooks that you hear, because a lot of this data undergoes revisions. All right, number seven. This is the last one and maybe the most important one. Barry Habib. Barry Habib, as some of you know, has been analyzing bond yields, economic cycles, and predicting interest rates over the last 25 years. By far, he has been the most accurate of predicting these cycles and when interest rates are going to increase and decrease. He is a strong advocate for interest rates moving down in the short term over the next 12 months. Now, the timing we never know about, and things can change from day to day, but of all the experts, he is by far the most accurate and he has felt that sentiment for the last year that interest rates will fall and fall sharply at some point in the next 12 months. So in general, I know it's a tough time right now in our discussions with our clients, navigating our business, but I believe that there are a lot of reasons why we'll see interest rates decrease, which will ultimately create more opportunities for us and our clients. So stay tuned. In the very short term, I will provide some additional commentary on why this is actually an advantage, and how we can structure opportunities with our clients, even with rates being at 7% right now. Thanks.